If you have a 500k mortgage and your household income is 100,000, that's a debt to income ratio of 1 to 5.
Yep.
So when you're starting to get to the 1 to 7, 1 to 8 or beyond that, that is the point where we're really deeply uncomfortable.
Welcome to Where's My Money? One man, $1 million of debt, one podcast to find a way out.
This is one for the mortgaged, the indebted, the poorish ones, the ones who owe a shitload of money to the bank to have a roof over their heads and hopefully in time make some cash and retire early. Or something along those lines. Welcome back to another ep of Where's My Money? It's a mortgagey one, with two of my favourite smart cookies from Enable Me popping in for a chat to break down a few of the ideas we have about mortgages, the best ways to smash them, and some views on how we play the interest rate game. Don't forget to follow us on Instagram for more of this content so you can be better with your money and sleep a little better at night, at Where's My Money NZ on Instagram. And just a reminder, this podcast isn't here to replace any financial advice, as we can't take your own personal situation into account. We would love it if you were to go and seek some good, solid advice from a trusted financial strategist, coach, advisor, or other personalised advice. Good? Great. Let's get stuck into mortgages. We all love the idea of being mortgage-free, but is that dream still realistic in New Zealand right now with rising interest rates, stagnant wages? It's all sounding very investigative and journalistic-y, but that's not me. The cost of living is squeezing every dollar out of us to the point where I'm just angry at the world. So is paying off your mortgage still the smart move? Or should we just be getting by and just, putting things off? Joining me are Enable Me coaches Justin and Shelley to tackle the big questions. How do we get ahead? How do we stay on track? And is being mortgage-free even possible in our current circumstances? So let's start with the big one. Is it realistic for the average Kiwi to aim to be mortgage-free, or has the game changed so much that we're kind of screwed? Justin, I'll let you take this one.
Yeah, well, it's definitely got to be the aim still.
Yeah.
It's harder than it probably ever was because, the size of the mortgages are harder. But, yeah, with a good plan in place, it's definitely still achievable. And one of the main pillars of things that we want to focus on is biggest bang for our buck. It's the highest cost, household budget. So it's got to be the thing you tackle off first.
And you're not necessarily talking like someone doesn't turn up at Enable Me and you go, right, we're going to have you mortgage-free in 2 years, because that's probably not realistic.
Probably not, no.
But if you can take 8 years or 10 years of someone's mortgage, which is, almost, it could be a third of the entire term, that saves them hundreds of thousands of dollars, eh?
Yeah, exactly. If we can just create enough of a cash surplus to more money in than coming out, and we can talk about different ways to do that. But when we get that surplus, putting that to work against the mortgage can smash down the amount of years and be worth hundreds of thousands of dollars.
It's just hard at the time to see that.
It feels a bit like wizardry, doesn't it? On the other side of it, like how do they come up with something like that?
Yeah, because I think about that all the time when we came to Enable Me and Hannah suggested with a quick tweak to the strategy, we could get rid of 8 years pretty quickly. And if we wanted to play the game really hard, we could be mortgage-free in 10. And I was like, this is amazing. And there are some days where it's just like, oh, this is so hard. But I can't imagine getting to the other end of this and looking at myself and going, you dickhead, you could have said, like, you could have been done. If you'd followed that game, you could be 450k further down the track and be done with this mortgage bullshit. Like, the fear of me being angry at myself is almost enough to really want to do it.
Keep you doing it.
Like,
Yeah.
Don't be a dickhead. For someone who is feeling stuck, though, because it can be pretty daunting, paying down a huge mortgage on a modest income, which, like we've said, wages are stagnant. A lot of people aren't getting pay rises at the moment. A lot of people are losing their jobs. Shelley, what would you say is the first thing they need to get real about?
Yeah, and it always comes down to sit down, make sure you and your partner are on the same page, look at what your goals are. Then we understand, well, what is your asset position here? What is our starting point? And actually, what is your current trajectory? Like, a lot of people don't look at their banking app and go, oh gosh, golly, I have 25 years to go on my mortgage. They don't even realise that. And scarily for some people, they don't realise that pushes them past age 65. So it's really just getting that first understanding of, well, what are we actually on track to do right now? And getting a bit of a reality check around that.
Absolutely.
And then understanding, well, if we can get some really beautiful systems set up to help you minimize that leakage, that slippage, that what we call fritter here at Enable Me,
Yeah.
we want to try and capture that and channel that towards debt. And if your debt to income ratio isn't too high, then we can get you mortgage free in a reasonable time frame, because the beauty of fritter, it's not a great thing, but the beauty of capturing fritter is that you should feel no worse off. And if we then channel that towards the mortgage, it's just going to accelerate you ahead.
Yeah. It's interesting you talk about the, people looking at their banking app and going, 25 years, 15 years. If you play with the numbers and it adjusts, and you can start to visualize how soon you could be mortgage free. It's funny that the banks give you that tool, but also I think we've been led to believe that buying a house and owning the house you live in, that Kiwi dream, it's just part of it. You just get a 30-year mortgage.
Yeah.
So I think it does take a bit to unwire what we've learned, which is when you own a house that you live in, you have to have a mortgage for 30 years, because it's probably what a lot of our parents did. They just sat there and paid it off and chipped away, and that was it.
They did. However, our parents' generation, it was actually a 25-year term. That 30-year term is quite a recent thing.
Okay.
Yeah, maybe the last 10 years, something like that.
Yeah.
And even the generation before, it was a 20-year term. So the system for our grandparents was, they bought their first house in their early 20s. They were on a 20-year term. It put them into their 40s.
Yeah. And
So
that was
now the average age that people buy their first home, because it takes them longer to save up the deposit, is age 35. And
Add
you're on a
30 to
30-year
that.
term.
retirement. Bam.
Exactly. So the system in this country doesn't really work anymore. So you cannot be complacent. You cannot just follow that system, because it doesn't work.
Nothing makes sense. Eh?
Doesn't
It's
work.
kind of like
Yeah.
when you have kids and you have to go back to work, and you're like, wait, hang on. School goes from 9 till 3, but I'm meant to work 9 till 5. There's two parents that have to work 9 to 5 to afford the mortgage. Like,
Yeah.
nothing really works
Yeah.
right now, and it's so hard.
No, and an interesting story. Sorry, Justin, before you launch into that, I was talking to a work colleague the other day, and she said literally her second daughter was born because they had fixed in a low interest rate. They would not have had her if they didn't have a low interest rate on their mortgage.
Whoa.
They couldn't have afforded her.
Yeah.
Isn't that scary? She wouldn't exist.
Human life is on the line here because of interest
Yeah.
rates. God damn.
And just one thing, when we talk about owning a home, I like to frame it with a lot of first home buyers that point actually comes when you own more of the home than the bank actually owns.
Nice.
So you get in with a 20% deposit, the bank owns 80% of that property. So what we've got to do is get that mortgage down, and over time, obviously, hoping the property price picks up,
Yeah.
that'll flip that 20/80 to 60/40 your way, and that's the moment you actually own, not fully mortgage free, but you
No.
own more of the home than a big organisation like one of the
And
banks.
then you've got a snowball of repayments that can really get rid of it faster, or
Exactly.
you've got equity you can leverage and
Yeah.
buy some investment properties. See, I'm learning. I
It
listen to what
hasn't
you
gone
guys
that
say.
way, however, because a lot of people did buy at the height of the
Yeah.
market, and it's kind of gone 90-10, even if it was 80-20
Yeah.
to start with,
Yeah.
And
which feels hard.
A good thing to keep in mind if you are in that example is it's always focusing on what you can control as well. You can control your cash flow and mortgage strategy. You can't control whether your suburb's going to go through the roof or not.
Or interest rates.
Just do what you can do. Give
Yeah.
yourself that best chance to get to that position where it's more in your favour than the banks, and then you've done all that you can. Everything else happens in the background, and you've done everything there within your power.
What happens if you do end up underwater? Like if you all of a sudden your house is worth less than you paid for it, and your lending is out of kilter with the value of the house? What happens there?
It's hard not to feel really down about that, right?
It's
Yeah.
scary.
Yeah.
Because there's probably a lot of Kiwis that are in that position right now.
There are, yeah. And for some of them, the line is just hold your line. For others, it's let's think of a different strategy,
Yeah.
and it kind of depends on their goals and their plan. But for some of them, it's just, it's just what it's worth on paper.
Yeah.
We're not
Exactly.
necessarily going to lock in that loss by selling it. If we were, we would have another strategy around that.
Yeah. Because if you locked in that loss by selling it, you'd still owe money to the bank that you couldn't pay them. So,
Exactly.
that's terrifying.
Yeah.
And
Yeah.
the
And
bank
we
needs
had a
to kinda
couple
go-
last
As long
year,
as-
didn't we, Justin?
Yeah. As long as you can continue to make your repayments, though, the bank's not looking at one roof or homes any given day saying this is now in that position.
I'm looking every day. I'm looking every day.
So they've signed that 30-year term with you. You just, as long as that repayment schedule's kept getting met, which sometimes, there are those harrowing tales where it's not and it gets looked at.
Yeah.
But, keep chipping away at that term. They've
Stay
signed
away
on.
from the bank.
Okay.
Yeah, stay away and just keep them happy. And
Yep.
they know, you know, there's cycles in markets that will float back. The LVR will float back the other way as long as you're meeting your end of the bargain.
That feels like really good advice. I feel like there are a lot of people, potentially me included, that would panic. This asset's wrong. Sell and run for safety. Then you've really locked in the loss and you've all of a sudden got a bit of a problem. So you need to know the numbers. If Kiwis are looking to sell their home as part of a strategy to put their money into investments elsewhere, weathering a bit of more of the storm for say 12 months and waiting for house values to maybe come back to a more pleasing figure, or just pulling the trigger and going balls to the wall on a completely new strategy, you should probably know first what the most achievable timeline is to pay off your mortgage. What's the best way to figure that out though? I put that question to our experts.
There's a bit of math around this, and Justin's the guru when it comes to that.
Yeah.
Thank God you're here.
Yeah.
Because if it's something that's hard to visualize for someone who's not great with numbers, and there's a lot of great calculators online, but again, understanding it in layman's terms is often real helpful.
Yeah. So in layman's terms, it comes down to a simple formula. Well, there's a lot of calculus, complex formulas. That's probably
I love how
not
you
for
said-
another time.
You said simple formula and then had a smirk on your face. I was like, this
Yeah,
isn't
there's a simple
simple.
formula that goes into a more complex formula, but the simple formula is what is your cash surplus? And that's just cash income, so what you paid after tax minus all your expenses.
Yep.
And a lot of people come to enable me or just have their own budgets, and they won't factor in things that don't happen frequently,
Yeah.
that happen every year. You're going to need something for the car.
Yes.
You're going to need some clothes. The amount of times people say, well, I don't spend anything. Even the people with, clothes they've had for years, be a few $100 a year.
Yeah.
There'll be gifts. There'll be all those things that might happen once or twice a year max.
Jesus has the same birthday
Exactly,
every
yep,
single year,
exactly,
so Christmas does
yep.
not change.
I see, clients that come, and if they've got kids listed down there and they forget the gifts budget, I've got 3 myself, there's a budget that's happening there, and it's more than you think.
Oh, yeah.
Or they underestimate too. We can kind of get to go into that rabbit hole too.
We're not
of-
extravagant, they say.
Yeah.
Sure.
Okay. Yeah. We can pick holes through that, but we want to get the most realistic version of that formula, and then work through where you are now and what's the best version of that we can get to.
So that's the other thing too. You're not the police. You're not trying to catch people out and get them in trouble. You're trying to help them. So be
We
honest
want-
with yourself.
Yeah,
Yeah.
we want them
Budget.
to have visibility, and so
Yeah.
we actually track our clients' spend, as you know.
Yes.
But it's not for us to kind of growl, it's for
to give
them.
the strategy and advice that's
Yeah.
right for you. Because
Yeah.
what's
Yeah.
right for you, the person down the road who earns the exact same amount, is 99.9% chance not right for that same person.
Yeah.
That different person in the same scenario will have their own tastes, their own number of kids' birthdays or no kids' birthdays. They might have a car that's completely fine and covered under warranties or whatnot. So every person's situation and formula will be very different, and their strategy needs to match that.
There is a little bit of, you can kind of look at that whole debt to income ratio thing, which I know you've kind of understood in your own situation.
Yes.
And
Worn the
we're-
weight of on my shoulders
Yeah.
for 2 years. Yep.
And when we calculate debt to income ratio, it is your before tax annual income as a family, how many times that goes into your mortgage. And so for ease of math, if you have a 500k mortgage and your household income is 100,000, that's a debt to income ratio of 1 to 5.
Yep.
So when you're starting to get to the 1 to 7, 1 to 8 or beyond that, that is the point where we're really deeply uncomfortable. So it's kind of an easy calculation that someone at home could do to go, well, yeah, what are we earning before tax as a family? And how many times does that go into our mortgage? If it's around about the 4 to 5 mark, maybe 1 to 6 at a stretch.
1 to 4 to 6, I'd say.
Yeah.
Then that's a sweet spot, I'd
It's a
say.
sweet spot.
And then from there it becomes we should be able to then have a surplus in that other formula of a couple of grand a month.
Yep.
And we might not have that yet, and we can,
Maybe
go
frittering.
away,
We need to
which
find
is
that
very,
surplus.
Yes.
very, very common with most people, that there is a little bit there that can be improved upon, including the mortgage strategy itself. That's one of the biggest areas of fritter, which we can touch on. But unlocking that $2,000 a month, that's where the magic then happens in the more calculus and more in-depth formula of how we can get a 25-year trajectory down to 12 to 15 and save that hundreds of thousands, because we've freed up that $2,000 a month. And that's only possible when you do have that debt to income ratio of 4 to 6. If it's 7, 8, it's going to be very tight and
There's very little
very
disposable.
hard
Yeah.
to have more than $1,000 a month left over, maybe even less.
Yeah.
And then unfortunately, sometimes when that's the case, I don't have the magic wand to just make it happen.
We might have overcommitted.
Yep. And that's where we need just a different strategy.
Yeah.
And
That's
a
it.
positive outlook.
Yes.
And some sleeping pills. When Justin mentioned mortgage strategy being something we can touch on, I was keen to jump straight into it. I feel like we're bombarded on TikTok and Instagram by mortgage advisors and finance bros claiming they've got all the answers as a way of drumming up new business. And maybe they have the answers, or maybe they're just dishing out more of the same old. So let's touch on it. Is there a magic mortgage structure or strategy that will help us get debt-free faster?
Yeah, well, without obviously going into boring calculus, because I'm sure that'll be terrible podcast listening, but...
It is nice to have numbers though, like Shelley explaining that debt to income ratio calculation is pretty good.
Well, probably one of the biggest ones that I think people are not across before they come to us and we take them through, and it takes time to get the right figures for them, is we get an obsession with where the interest rate's at.
Yeah.
Okay, what's the interest rate per annum?
Justifiably so, because it makes a huge difference with
does.
your repayments.
Absolutely, but we're not seeing jumps from like 7 to 5 where it makes such a difference day to day.
Yeah, and it
all
will,
the time.
but we need to move away from being a nation obsessed
Yeah.
by interest rates,
Yeah.
is what Justin I think
And
is trying to say.
and the strategy itself, you know, and I say this, I said it to clients when the rates were super high, and as they're dropping now, a portion of that loan, if it's strategically set up, you can beat whatever the interest rate is that's everybody's, you know, super happy about by 2 to 2.5% by having a strategy in place for a portion of the loan.
Please go on.
Wow.
Yeah.
So what we recommend, and people come to us and they've got a 25-year term, 20-year term, 30-year term, whatever, and they just want to start paying the mortgage off, you know, but it just seems so insurmountable. It's kind of like, I want to pay my mortgage off as fast as possible in the next 30 years. It just seems like, how can that ever be? And even if we shave 10 years or 15 years off that 30-year term and it's sitting at a 15-year, that's still kind of a long time.
Yeah.
So the art of it is to break it down into short term. Humans are goldfish. We have a very limited attention span.
Absolutely.
And sticking to stuff, we're not so good at it. So let's break that mortgage down into savings targets that feel achievable. And then we have check-in meetings within those savings targets to make sure that we're measuring progress. And we go right granular,
Yeah.
don't we, Justin?
Yeah.
It's like the balance of your mortgage should be
In 3 months'
in
time.
3 months'
Yeah.
time.
And probably the beauty of this is, again, through no fault of any particular bank or anything, but we're preconditioned to a per annum interest rate.
Yes.
But interest on the right portion of a loan is actually calculated on a daily balance. So if you can get that down to zero over the course of the year, you haven't paid what the interest rate was on the starting balance. Because if you think about it, if it's 50 grand at the beginning of the year and it's on 25 grand 5-6 months in, on that day, you're only charged interest on 25 grand, not 50 anymore. So rather than that 50 grand being fixed in at 5%, if you've paid that down over the course of the year, you've probably paid less than 3% interest on that 50,000.
Yeah, so Justin's alluding to the whole revolving credit piece.
Yeah.
So, you know, when I say we break the mortgage down into savings targets, we only want to we only want to float what you can
right amount.
conceivably pay off over a 12-month period, because you pay a premium to float.
Yeah.
Of course.
So we want to go, well, hey, what is that surplus?
Yeah.
What is that amount, that extra couple of grand a month that we can find that usually we see being between 15 and 20% of what's coming in the door?
Right.
We want to try and keep.
Yeah.
So again, if 100,000 is coming in the door, we want to try and keep 15 or 20 if we can.
And that's that for a lot of families, that probably feels quite achievable in terms of across a year.
Yeah.
Save 15 grand,
Yeah.
which is actually
And what
paying
is
off
that? And what is that per month?
Yep.
And so let's float that amount. And we like to float it in a revolving credit, because when you use a revolving credit, when you pay down that revolving credit, obviously we're offsetting interest.
Yep.
You only pay the interest on the balance of that. We say the effective interest rate is half of that floating rate, so it's 6.75, 3 point whatever percent on that, because it's on a reducing balance. But the beauty with a revolving credit is you can
access it again.
re-access it.
Yeah.
So that's the flexibility part of the plan.
And it's a safety net.
Yeah.
And it's, well, it's not even just a safety net. It could also be used to invest in other things, right?
This is it. And every year we've got that another mortgage coming up, and this is our target for year 2
breaking
and
it
year
down
3.
into those bite-sized pieces, as Shelley was saying, we need to know what to do in the next little bit. Not there's 600,000 owing, I need you to be 580. Like, it's really crystal clear of the next point is get this to 0. How are we going to do that? You be here in 12 weeks' time.
So if someone was already quite diligent with their mortgage then, and they had their repayments and they said, I'm going to increase our monthly repayments by $500 onto a fixed loan, you're suggesting great attitude, but let's
great
throw that 500 at a revolving credit portion rather than a fixed, because you can get that baby back out if you need it.
Back out,
Not
and
that
you're
we want
playing
you to take it back out.
Not for spending on shit, but
well, more
safety
importantly,
net and for reinvesting.
More importantly, though, we want to play that game with that portion of the loan with the maximum amount. So rather than it be 10K, if it can be 30 because you've got an extra 20K available, let's play that game with the bigger amount, because that's getting a 3% interest rate. We're all super happy about fixing for 2 years at 4.99 if you hear anyone at the moment.
Yeah.
But wouldn't it be great to get 3%? If you said that to anybody at the moment that's hearing about 4.99, they'll all bite your hand off and think, what bank's that?
Yeah.
But it's actually what you can do with the right strategy.
You've cracked it. You've cracked the code. Okay, well, are there any other hacks in terms of the frequency of payment? Because in my I'm not super smart, but I'm also not super stupid. And I'm like, does paying it off every month versus every fortnight versus weekly actually make a material difference to someone's...
It makes a difference.
A difference, yeah.
Yeah, so if you're... Usually people tie in their mortgage repayments to their pay cycle.
Yeah, totally.
Because
so it's predictable.
And it's easier to manage that. So I guess if you you pay less interest if you pay a weekly mortgage repayment. That's just math, because you're, like Justin said before, they calculate it on a daily basis. So if you're making extra repayments, it's on a lower amount, for the rest of that month.
Yeah.
But it's not overly material. So from a cash flow perspective, if you're paid monthly, probably just tie it in with a pay. Paying extra principal off on your mortgage is always going to hands down beat any incremental change. That said, if you're on a weekly pay cycle, sure, pay it weekly. You might like to set aside money from your monthly pay into a mortgage account, and then it goes out on a weekly basis. That could be another practical idea. It does make a difference, but not as much as paying off extra principal on your mortgage.
And not as much as having good structures and disciplines in place in other areas would be the counter to that too. Because like we said, 15 to 20% of people's income's getting frittered away in just little bits and pieces. It's not actually worth that much in the grand scheme of things.
All right, so how can people approach their mortgages in 2025 with interest rates looking kind of unpredictable? Because last year it was all about they're coming down, and then there was a little bit of they might be coming up, and then they were coming down, and then someone else is going, lock in for 5 years, guys, because they're going back up. What do we do? Like,
So
I know you've said not to dwell too much on the rates, but people do make big decisions based on how long to fix for, particularly if they're flying solo without good advice.
Yeah, look, it moves around so frequently, this stuff, that you really need to know what's right for you at any given moment. So the way I like to think of it, and when I talk to my clients on this, is why do you think the bank's offering you something like that might look attractive and shiny? Because probably by the time it comes off, it's going to be a lot lower, or even before it comes off, it's going to be a lot lower. That's their crystal ball game of where it's at. Everyone will have their own different crystal ball of it, and none of them are going to be right. It's just who's closest to the pin. So you've just got to think through with the clients, or anybody out there, think about when you see what the bank's offering you, there's a reason for it. They think it's likely to be a lower point closer to when you're going to come off.
They pay people lots of money to figure out what might be happening with interest rates moving forward. So, but I think in the absence of a specialised, coached mortgage strategy, a lot of people like to hedge their bets by actually dividing the mortgage up. So you might go, into thirds and go a 1 and a 2 and a 3.
Which slowly exposes you to something if it's gone up. It's less of a shock to the system and to the budget.
A little bit more access to, if rates do suddenly drop, that you've got something coming off at least in the back end of 2025. So if you don't have a set strategy to have a portion floating, etc., it's really common. Some people don't even realize that they can have more than one mortgage on the one property. They can have it split.
Yep.
You know, so that's a good way to hedge your bets a little bit there, and don't just be stuck in on one whole loan. And, you know, as long as you're making the repayments, you're not in any trouble, but yeah, you're just de-risking yourself, hedging your bets a little bit.
Yeah. Another thing to add to that would be, you know, some people really struggle with certainty and they really worry and it eats away at them at night. Hey, if you can get a really good interest rate that you can afford for the next 5 years and that serves you, do it. If it takes the worry off your, you know, off your plate for the next 5 years. It's not really
black and white, is it? Because we're all individuals, so we've got different risk comforts to where we see this fit. So for someone, it might be, I just want to see it start with a 4. Don't care what it's moving for the next 2 years.
Yeah.
I just know that that's going to make, and it might be the right thing for them, a real good cash flow impact to us, it being that low. Someone else might want to be like, yeah, I reckon I don't mind what it is in 6 months. I think in 6 months it's going to be this. Okay, cool. Let's go down that approach.
If they want to play the game, cool. If they want consistency so they can sleep, also cool.
The risk, of course, to fixing for a longer term is that you can't make extra repayments on that loan.
Yeah.
However, some banks do offer an ability to pay off an extra 5%. So I know ANZ and Kiwibank do that. You can actually, even if you have a fixed term, you can take 5% in that year of when the fixing rolls over.
Yeah.
So you could actually pay 5% on one day of that when the fixing rolls over and the next one of that kind of anniversary. So you can, you know, have that certainty for maybe a 3 or 4 or 5 year period, but you can still make those extra repayments.
But you got to have that as part of the plan too, because you need it sitting there ready to go.
Yeah, that's it.
And some people that are super number focused and really want to play a game with the bank, you just need to see the gap between the different rates on offer. And then what I do with some clients that are super number focused is I say, okay, well, if you fix for 24 months, you've got 24 versions of this interest rate. If you fix for 12 months, you know you've got this for the next 12. What does it need to be in 13 months' time for the following 12 months to be for that version's 24 to be less than that fixed version's 24, and say, you know, we play a bit of a game. What do you think 2026 is going to look like? 4 point whatever. Cool. Add all that up in the 5 that you've got now, and you are no better off than fixing, or you're way better off. You know, so you can. Some people are super wanting to play around and get into the details, and you can play that game off with them to say, well, here's what certainty looks like. Here's a little bit of a blue sky thinking version of some shorter term rates, and work out what actually will work out number wise best for you. But
turn it into a game.
Yeah.
But don't get hung up on it. Don't get hung up on it.
Yeah.
Make a decision and move on.
That's where I sort of get to them with it is, this is all well and good. We're trying to beat the bank and, you know, they make enough.
But like you've said, that's not going to beat a really good strategy.
Better strategy has a 1 or 2 number better rate on it by you controlling your own controllables. So yeah, we're playing off the bank here in the 0.5%. You with the right strategy can beat that bank by 1.5 to 2.5%. So
awesome. Something we did when we had our first house was increase our monthly repayments. It seemed like a fiscally responsible thing to do. We could afford it at the time because our debt to income ratio was way healthier than it is now. And I don't know, it just felt like we were winning because we were tackling principal faster instead of just tickling the interest around the edges. So why wouldn't we all do that if we were in a position to? Shelley and Justin have some pretty good answers to that.
You've got to be a bit careful with that. So kind of it goes back to what we were saying before about the flexibility.
Yeah.
If you are in a situation where you keep your payments high, great, and the intention is there that we're paying off extra principal every month with that 500 that might be freed up or whatever. The risk to that is if you have an issue with your job, and as we know at the moment, there are redundancies, restructurings, and unemployment's rising, you are now on those fixed repayments. So you've just inadvertently increased your
fixed outgoings,
or kept them high when you could have actually dropped them down. So
So if you lose your job, you're not going to be. You might not be able to meet those repayments, and then also if you need to change them, you're going to have to pay a break fee, which is costing you more again.
And you're going back to the bank when you don't look as attractive.
Yep.
Yeah. You know, and then you're in the hardship team, and you're on your hands and knees pleading for them to please, can we go interest only or have a mortgage holiday? So we do not recommend.
My friends at the hardship team, hi guys, if you're listening, we went there, but you know, levers have got to be pulled. All right, well, that's a really good point. So, and that's where the an offset account or a revolving credit gives you flexibility. It's great that you can make those repayments, and you can, but all of a sudden if they disappear,
there's so many ways, like redundancies, unexpected baby or illness or something that's changed the work scenario in a family.
Yeah. Injury, got to move out of town.
The income stops,
completely
and
gone.
we're up the creek.
So you've got
policy
intention.
changes and daycare funding disappears. Like, who knows?
Yeah,
all these
anything
things.
could happen.
Yeah.
Totally.
So we need to be as resilient as possible with our mortgage strategy.
Good answers there, team. Okay, time for a couple of hot takes from our experts. Some quick fire questions about interest rates and other mortgagee stuff. What's one mistake people make when they think the worst is over and interest rates start to drop? What do?
They stall and coast would be the most common. Got an example recently over that summer period with some clients who just coasted along because, it just felt a little bit easier. They met with me pre-Christmas and the outlook was going to be fantastic for 2025. I set them a target, met with them recently, went way over, talked to them about, the upcoming plans, and they've said, we're going to have to shelve a family trip for a wedding to Europe. And I ran some numbers on that trip to Europe, and what they overspent by over the 3 months actually pushes them further back on their mortgage than one life-changing trip for the whole family. So coasting is the most frequent thing that I think people do when things get easier, and it actually can be the most costly thing because it becomes a habit. That 15, 18, 20K a year of overspending is going to happen for those guys if they don't correct it for the next 8 years. That's 160K. The trip's 30 to 40K. So the trip's a quarter of the cost of them coasting over summer.
So how do we twist that on its head then? How do we pivot and say we're actually going to make the most of this situation?
Yeah, I'd probably say, we've all been doing it tough. So it's not about forcing yourself to not have any fun when things loosen up, but do it purposefully. Do it in a way that's accounted for, and that it's not a thing that's going to become 52 weeks of the year for the next 10 years. Set aside some good fun things to do maybe this year that aren't through the roof, but you're just doing it in ways that you're in control of rather than it becoming a habit, and that keeping up with the Joneses has set you back 4 European trips over the next 8 years.
It's a good way of counting. How many European trips have you lost this year? Yeah.
They're priceless. That's memories, right?
Totally.
Yeah.
And it's
I'm not suggesting everyone go out and
no,
book a trip to Europe.
and for these guys, it wasn't, because they technically have enough buffers in place to maybe be able to do it, but they thought coming to meet with me that I was going to be like, no way, that's going to blow up the strategy, push the strategy out by a year. But what we had discussed earlier with them had pushed the strategy out by 4 years.
Wow. And as we said before, 4 years of a mortgage can be hundreds of thousands of dollars in interest.
Yep.
And they can't even really remember where it all went over that 3 month period. It was just stuff and summer in Auckland, summer where they've been, for years and years. And there's this one wedding, once in a lifetime thing with the kids that they'll remember forever. And that thing could actually, cost them a quarter of the amount of bad habits.
Wow.
I've got another hot take. There's opportunity this year. You've got a little bit more cash in your pocket if you're lucky enough to still have a job, even if you haven't had a pay rise. Interest rates dropping are giving you opportunity, another cash surplus. Get excited about that opportunity and take it. Does that mean that we can get on the property ladder? Does that mean that we can buy an investment property? There are opportunities out there at the moment to be taken. So if you can, do.
Change your mindset. It's not all doom and gloom, right?
Get excited about, what we can do rather than worry about what might happen.
Yeah.
Be brave enough as well to be early on that train and not wait till it's everywhere, because the price point would have moved through the roof. If you could have, that's the right time. And it's not worth looking backwards in 2 or 3 years' time through the rear vision mirror and say, I wish I did that. When, if you think there's an opportunity there, and there possibly is, and you've explored that opportunity, be brave and take it.
Yeah.
Thanks a bunch to my legendary guests, Shelley and Justin. They're real good chats, and I love them as a combo, actually. Bright and punchy with the numbers to back them up. It's awesome. Don't forget to like and subscribe to the podcast wherever you listen, and tell a mate. Building our fan base means there's going to be more episodes for you in the future, so you can be better with your money. Speaking of the future, in our next episode...
I don't think the Kiwi dream is dead. I think it's changed a little bit. I think people have to be more patient. They have to be more creative. And at its base, they've got to be more ambitious in terms of what they would like to achieve. Knowing that like previous generations, it doesn't just happen. Your first home is not going to be your forever home. Let's just call it out.
Yeah.
It is part of a journey, and I think that potentially the first home that you purchase might not even be the home that you live in, but you're on a path to financial freedom, to have your own property, family, etc. But you've got to be creative in terms of strategy.
Yeah, is the Kiwi dream dead? We'll have a good crack at finding out. Until then, though, I'll keep asking that question, where's my money?